I understand JPMorgan just revised down its Brent forecast overnight. Just walk us through the thinking now, and how are you factoring in the demand destruction that we're about to see?
Yeah, so we revised our Brent view is now 36 this year and 35 next year. We think there's going to be an inventory build this year of about 3 million barrels per day. That's 3% of global oil supplies or demand. And basically it relates to the ramp up of OPEC output into next quarter post the OPEC meeting the other day. We see a sort of Brent low of, on average, $27 next quarter, but a low case scenario of around $17.
Oof. What would the world look like at that $17 level? In other words, I know that's worst case, that's not base case so far. What needs to happen for us to actually get there?
Look, I think there's a lead time of Middle East loadings to Asian clients, and that could be 60, 90 days, and that's why I think 2Q is quite significant. And then we've obviously, come off a low demand quarter, particularly over here in China, and then you're going to see that elsewhere in Europe and the US. So you're seeing oil demand down maybe 1 million barrels per day year on year this year, but assuming the virus does clear out at some stage this year, then you could see a reasonable recovery in demand growth next year. We're forecasting, I think, 1.5 million barrels per day global oil demand growth.
And when it comes to the oil and gas producers, I'm sure this is like catching a falling knife now in terms of earnings downgrades. How are you playing this out right now? How are you basing your base case scenarios on earnings projections now for some of these oil producers?
Yeah, so we've reset our earnings recently. Look, if we look back at other oil price collapse, whether it's 2015 or 2009, in this part of the world, you tend to see the refining and chemical companies outperform the upstream oil companies. And in particular, in this part of the world, China, bear in mind that for some of the Chinese refiners, the government set a sort of $40 oil price floor. So at $30, I'm effectively buying at 30, and I can sell at the equivalent of $40. So that's quite significant to some of the refineries, and that's why we've skewed a bit more positive to those.
Right. Does that mean then, that call to go, I would imagine very simply, to go long refiners, does that bullish call get stronger the further the oil price falls? Just clarify that for us.
Yeah, if you look back at, last oil price collapses, of course, you're going to get inventory losses for some of these companies, which you're going to see in 1Q results. And the market, we would argue, sort of price that in. So the longer we remain, as long as it's sort of stable around, let's say, a low oil price level, and for the sake of argument, let's call around $30 a low oil price level, then effectively my costs, whether it's a refinery or naphtha cracker, you've just had a 50% discount on your costs as we get through the inventory issues through the wash. And that's why when you look back at absolute share price performance, it was some of these downstream chemical names which did better than upstream. I think if you're taking more of a medium-term view, that we can talk about $30 or $40, but JPMorgan's long-run oil price still remains at $60 Brent from 2023 onwards. And I don't see why dramatically the cost curve for oil changes to a $30 level in the longer term. At the moment, the industry needs at least $60 for a lot of these investments. So you're going to see delays to sanctionings of projects. But as long as you really believe we'll get back to a long-run oil price view, then some of these oil equities, which are already discounting, we think, around $30, $40, if you're taking more of a medium-term view, look actually good value.
And Scott, just real quickly, what does this mean for the future of OPEC Plus? Do you think that this relationship with the Saudis and the Russians are repairable?
Well, our base case would say yes. We think this goes on for a couple of quarters, and then there's some kind of negotiation. If you look at Saudi fiscal break-even, we think it's around sort of $45 to $50, and Russia around sort of 25 to 30. So we certainly would debate whether this can go on sustainably. It certainly wouldn't be in the interests of those countries.